The expectation is that the Fed is going to raise the interest rate once again, the third time in 6 months. Scott Gamm of The Street joins us now ahead of today's important rate decision. Scott, welcome back.
Thank you.
So has the Fed backed themselves into a corner here?
Well, look, I think the Fed is definitely going to raise interest rates. There's a nearly 100% chance of a rate hike. But the big question is, what will the Fed's outlook be? Because we went into this year with the Fed saying, hey, look, there's going to be 3 rate hikes in 2017. The big question is, do they up that number to 4, or do they maintain their outlook? And that's what the markets are going to be watching for. And the other thing is, I think the Fed has sort of lost its ability to manipulate the economy. If you look at some data, if you look at the Goldman Sachs Financial Conditions Index, it spiked in early 2016 after that first rate hike, but it has since come down. So you would think that raising interest rates would cause financial conditions to tighten, but we're actually seeing the opposite. If you look at bond yields on the 10-year Treasury, we reached a record low about a year ago, and yes, we've rebounded a little bit, but we're still very low at 2.2%. So that's another sign that, hey, financial conditions are easing, and it doesn't cost that much to get a loan.
Well, it seems the recent data doesn't justify a rate hike, but if the Fed were to take a more dovish tone, do they lose credibility?
Well, I think you could argue the Fed has lost a lot of credibility. They should have been raising interest rates years ago. But when you have an unemployment rate at or below 5% for almost 2 years now, you have to start tightening, especially if we were ever to go into a recession anytime soon. The Fed wants to have some dry powder to be able to either cut rates or help get us out of a future recession. So they need to start going now.
And if they start unwinding the balance sheet?
Well, that could raise interest rates. The Fed is a big buyer, of course, of bonds, securities. That's why they have a $4.5 trillion balance sheet, which has been just on the rise since the financial crisis. It sort of has been staying level since 2014. So if the Fed kind of cuts its bond purchases, if they start to shrink that balance sheet, there's going to be less demand for bonds. If there's less demand for bonds, bond pricing is going to fall. If bond pricing falls, yields rise, because we know they have an inverse relationship. And if yields rise, borrowing costs for consumers across the board, not just mortgages, but also car loans, are also going to rise.
Yeah, you mentioned the Fed losing ability here. It seems they really need to change perception here.
Well, look, I mean, the Fed has sort of always been caught in this conundrum, but I think the markets are still being driven by Fed policy. If you look at, a chart between the Fed's balance sheet and the S&P 500, I mean, it's just completely a direct relationship.
So we won't even play out a scenario here if they don't hike.
Well, they would shock the markets, because when you have investors pricing in a 100% chance of raising interest rates and then you don't do that, that's not what investors are going to want to hear.
All right, Scott Gamm, thanks so much for joining us.
Thank you.
And thanks for watching this edition of Kitco's Fed Preview. We'll have more throughout the day. Thanks for watching. Hey.